Great. So the focus of this session is on fixed income and how to enhance yield and improve diversification within fixed income. So we're going to talk about multi-asset credit, which is often referred to as multi-sector credit. So if I use multi-asset credit, multi-sector credit, it's the same thing, essentially. And we're going to focus on a few items. Where are we now? So what's the state of play with respect to an average pension scheme? What are we trying to achieve with multi-sector credit? What in fact is multi-sector credit? What's the universe? What does it encompass? What have we learned looking back over 2015 and perhaps over a longer period? What are the important considerations before one invests in multi-sector credit? What makes for a decent manager? What are the sort of things that perhaps I would be looking for if I was a trustee at a scheme? And then looking ahead, what are the top tips? We're in a very challenging environment with respect to volatility and events. So what are the top tips for 2016 and beyond? And what would a multi-sector credit portfolio look like? So getting right into it. So where are we now? Took a look at PLSA data for an average scheme, and in particular the fixed income allocation, which is on average about a third of the portfolio. And as you can see, around 14% would be invested in investment-grade corporate bonds, and the rest in index-linked gilts and nominal gilts. So looking at that credit component, I guess it's quite natural for a scheme to take the first step outside of gilts into corporate bonds and possibly use them as a liability matching surrogate. That's a natural step. So as a result, sterling credit is the first step after an investment in gilts, be they index-linked or nominal. So we're going to make the case today that you can enhance returns further by looking at a wider opportunity set and investing across the entire credit spectrum, not just in the domestic market. And in doing that, you can improve returns and therefore improve the funding ratio. And looking at the PPF index, the funding ratio for an average fund is around 85%. So by enhancing yield, you can improve that ratio. So the focus is very much on multi-sector credit approach to achieve that objective. So what are we trying to achieve? The first thing in making an allocation in credit is to improve the yield, the return of the portfolio, and to achieve a superior return. In doing so, when we look at the credit markets, we expect more volatility than in the government bond market. It's more risk, it's a riskier asset class. But it tends to sit in the middle between equities and government bonds. So we're trying to improve return with some additional volatility and therefore generate superior risk-adjusted returns. Looking at the global credit markets is important because in adopting a multi-asset credit approach, because when you look at the UK investment-grade corporate market, the market cap looking at the index is about 540 billion. And that sounds big, but indeed it's relatively modest. If you look at the global non-sovereign investment-grade indices, the market cap's 15 trillion. And that excludes high yield, so maybe another 3 trillion, and emerging markets. So it's a huge opportunity set outside of the domestic market, some of which represent decent opportunities. So we're going to make the argument that it's interesting, and indeed there's an advantage not to have all your eggs in one basket. In terms of the tools available in multi-asset credit, many mandates have flexibility around interest rate hedging. So that provides protection in a rising rate environment, something I think we'd all like to see eventually. Doesn't look like we're going to see it anytime soon. And also, other tools are available. If you're investing globally, you can make country, regional allocations, and that enables you to allocate away from hotspots. So, for example, in our MAC strategies, MAC multi-asset credit, back in 2011, 2012, we allocated away from the periphery. In 2015, we had no Greek credit exposure in our portfolios. Coming into 2016, we allocated away from the UK, given the risk around Brexit. So we didn't sell all of our exposure, but we certainly reduced our exposure to the UK. And that's something that MAC strategies tend to have the flexibility to allocate. So what is multi-sector credit? So we've got four components really, which are the main characteristics, represent the main characteristics of multi-sector credit. The first is active investing. It's very important for the manager to be able to invest and allocate dynamically across different sectors, different countries, different credit ratings, et cetera. The second is benchmark unconstrained. So what I mean by that is not being constrained by a tracking error. So you're not forced to rebalance and have the costs in less liquid markets or following an index. We use benchmarks all the time at my firm when we're running multi-asset credit strategies. But we're benchmark aware. We're not tied to a benchmark. So we use benchmarks more as a framework for risk management and a framework for investment performance. In terms of beta plus alpha, I guess I'm always asked the question, how much alpha are you targeting, and or are you just managing beta? Most back portfolios do both. So the way I like to think about it is that approximately 50, 60% or so of the portfolio, we invest over a longer investment horizon, so say 1 year to 18 months. The allocation is based upon things like the credit cycle, across different sectors, the government sector, corporate sector, household sector, financial sector, et cetera, and the economic cycle. And then we have more of an alpha component, which is the balance, say 20 to 30% or so, which is driven more on best picks, so best ideas, fund flows, credit event triggers, et cetera. So where we're trying to generate returns over a shorter investment horizon. And you put the two together, and that's the MAC portfolio. In terms of the style, this confuses people quite a lot. MAC portfolios tend to be more long-only, total return. They're often benchmarked versus cash. So you hear people say, LIBOR or cash plus 4%, cash plus 3%. Sometimes they're absolute return. So absolute return strategies tend to have the ability to short. They tend to be focused more on the investment grade arena, where it's easier to short because there's better liquidity in investment grade markets, et cetera. So what's in the multi-asset credit pantry? Multi-asset credit strategies normally cover most or some of these. Some are more higher return seeking, so they're more focused on non-investment grade asset classes like leveraged loans and high yield and emerging markets. Others focus a little bit higher up the rating spectrum on investment grade. And I think, if I were a trustee at a scheme, I'd need to take into consideration or look to take into consideration what were my liquidity requirements. So, are we able to invest in less liquid assets? And what sort of return am I looking to achieve? And make sure we have the right balance and the right alignment with respect to the underlying portfolio and the liquidity and return characteristics that we're looking to achieve. So looking back to 2015, which was a very challenging year, what sort of returns did we see globally? So this chart just represents or highlights the total returns across many credit asset classes on a global basis. And first thing I'd highlight is that investment grade returns were pretty mediocre in 2015. It was a tough year. I guess we had the volatility around Greece and the Greek referendum and the risks of Greece leaving the Eurozone in the second quarter. And then we had concerns about pressures on commodity energy prices, on China, slowdown in growth. So there's a lot of volatility in the credit markets. Then we had concerns about the Fed, where they're going to lift in September, and then eventually they raise rates in December. So investment grade returns were quite mediocre. And at the other end of the spectrum, you can see US BBB returns, US high yield returns being highly negative. So what drove that? Well, that was the energy allocation. So US credit markets tend to have around 12 to 15% of the market value in the energy sector. And obviously that came under pressure given the fall in energy prices and the expectations around increase in default rates coming into 2016, moving up gradually to around 5% or so. At the other end, in terms of the best performing asset classes, you have COCOs, so subordinated financials. And then you have peripheral debt, so a strong rally, largely driven by the ECB, QE, and I guess the slow healing that we see in the periphery and European loans. But a big dispersion over the year between the winners and the losers. If we look back a little further, back to 2002, across various credit sectors, so this chart plots the excess returns, so just the credit returns, so assuming every category is hedged, fully hedged for interest rate risk, going back to 2002. And what we can see in years where there's significant market turbulence, so in 2002, dot-com, the tech bubble, 2007, 2008, the global financial crisis, 2011, the Eurozone peripheral crisis, markets do tend to be correlated. But even when they're correlated, even when the different credit sectors are all positive or all negative, there is a large dispersion. So in 2012, for example, if you look at the best performing asset class in 2012, which is sub-financials versus the worst, investment-grade corporates, there's still a 16% in terms of performance divergence between the best and the worst performing asset class, which is huge. So the multi-asset credit manager plays in this zone. So the objective is to allocate more heavily towards those sectors which you believe are going to be the most attractive and the best performing, and try and avoid the sectors that you think are going to be more harmful, more volatile, with negative performance. Obviously, taking into account the mandate guidelines and the constraints, because if you focus on the investment grade markets, you're going to be limited or you may be restricted from taking non-investment grade exposure. So obviously calibrating the portfolio in line with the framework, the risk and return objectives, but playing very much and trying to take advantage of the divergence and the opportunities. And pretty much in every sector, it's quite easy to see the main drivers of performance. So 2008, 2009, asset-backed, you had the SIVs liquidating during the global financial crisis. 2012, sub-financials rallying. You just think about the ECB and the OMT announcement in 2012, and Mario Draghi's do whatever it takes, driving performance in the investment markets. So as we look ahead, we try and look for what is driving the market, what's oversold as well. It's important to be contrarian, but what are the fundamental drivers with respect to the credit markets? In terms of considerations before investing in MAC, I think the first consideration is what role does credit play within the scheme? Is it return seeking, relying more on an alpha component, so giving freedom for the investment manager to trade the portfolio more actively? Or is it more of a liability matching type portfolio, which might be invested in maybe less liquid debt or longer duration type strategies? Which parts of the credit market are you comfortable in holding? Are you comfortable in holding investment grade? Does that meet your objectives? Or are you happy to go down to non-investment grade? And within non-investment grade, are you comfortable with subordinated debt, which is more like equity in terms of its risk and has a lower recovery rate in the event of default? Do you want to place restrictions? So sometimes some of our strategies, we have restrictions where we can't buy anything that's rated CCC or not rated at all. Which currencies are you comfortable in holding? Are you looking for active currency management, or do you prefer a currency allocation, albeit on a hedge basis? What we tend to find in credit is that currency risk, currency volatility tends to dwarf credit volatility. So certainly for investment grade mandates, often we see a preference to invest globally, but on a hedge basis. What geographical focus are you comfortable with? Are you comfortable with developed markets or emerging markets, or a combination of both? Just the UK, so we can do MAC within the UK, but we're focused more on different credit sectors without the regional aspects, or Europe, or global. Many investors are now starting to look globally. I think I've touched on most of the other considerations. Liquidity is important, just to reiterate, and is the alignment of your liquidity requirements, is that consistent with the underlying investment portfolio? If you need a certain amount of cash to be generated for income, can a portfolio provide that? Then lastly, the subject of fees, as an investment manager, always the least comfortable discussion, but are you getting value for money versus a passive strategy? Multi-asset credit strategies are all about active management. They're not passive strategies, so they have to deliver. And many don't. So, are you getting value for money? How do you measure whether you are achieving value for money and make the appropriate selection? What makes a successful MAC manager? What would I look for and what do I look for with my own team? Certainly a strong credit bench, and I don't want to talk too much about Wells Fargo ECM, but we have a global credit research team, so 20 plus research analysts. So clearly you expect some depth and expertise with respect to credit. And because MAC strategies are investing across different sectors, what I would look for, if you're investing in a strategy which is more focused on non-investment grade, is individual track records. So even if the MAC track record isn't that long, has the team got a great track record in loans? Have they got a great track record in high yield? Have they got a great track record in financials? Have they got a great track record in investment grade? Do they manage on an unconstrained basis? If they're just benchmark huggers, they're not going to make great MAC managers, or it's very unlikely. In terms of risk management, do they have the appropriate tools available in terms of portfolio analysis, stress testing, in terms of decomposition of risk factors at portfolio level, in terms of performance attribution and analysis of the portfolio. In terms of collaboration, holistic approach sounds a little bit woolly. But when you meet the manager and the teams, do they communicate well? Do they line up, or are they siloed? You want teams to cooperate in a MAC portfolio. A siloed approach doesn't tend to yield good results. It tends to yield people being a little bit protective of their silos. And who's pulling the trigger? Who is the portfolio manager? Who is responsible for managing the portfolio, for doing the asset allocation in the portfolio, and nimble asset allocation? These portfolios are all about having the ability to make asset allocation decisions. So a good thing I always find to do is look at the portfolio allocation over time and see if it's shifted, and then quiz why was it shifted and what was the effect of making that asset allocation decision. If you see a very static allocation in a MAC portfolio, it would indicate to me that the portfolio is not being managed as it should be in terms of dynamic asset allocation. What are our top tips for 2016? So I put this together before today's ECB announcement. Our top tip is bank loans. We expect a high-yielding opportunity, particularly European bank loans. We like the fact that the market has very little retail money, so it tends to be very stable. A little more buy and hold investors. Very decent returns, high recovery rates. The market tends to have LIBOR floors, important when investing in the Eurozone. Given negative interest rates. Investment-grade corporates. Investment-grade corporates, I imagine, certainly Euro ones, are rallying today, post the ECB's announcement. They've introduced non-financial corporates into QE, which was a surprise. So they're going to be underpinned, certainly with respect to the ECB's announcement. We like financials. We like financials a lot more now than we did a few weeks ago. And financials were really in the spotlight in January because we had disappointing results from the likes of Deutsche Bank. You had various good bank, bad bank announcements made out of the likes of Portugal and Italy. And in Europe, banks are facing the challenge of negative interest rates and a very flat yield curve, which means it's very hard to make decent net interest margins. But in terms of the great trades in credit, on one hand, you've got the asset side of bank balance sheets where banks are slowly looking to reduce leverage and sell assets, and that trade's been pushed quite heavily. On the other side, you've got the liability opportunity. And because banks are slowly becoming better capitalized and running with lower leverage, investing in bank credit, we think, is a good thing. Generally, you want to invest in credit in sectors which are deleveraging. So, what's happening with respect to Europe's banks, we think is good broadly as a creditor and probably less good if you're an equity investor. So we like financials. We're sort of so-so on high-yield corporates. Spreads are a little bit wider, but the market is a little bit exposed to fund flows and what's going on in the States with respect to default rates, particularly around the energy sector. Asset-backed securities, we're sort of, there are selected opportunities in MES, ABS, and we're less positive in emerging market credit, particularly foreign currency, given the rising interest rates and the commodity cycle, rising US interest rates and the commodity cycle, the strength of the dollar, and US investment-grade corporates. So top tips. In terms of current opportunities, so here we've got a chart of yield versus duration. So you've got duration is the yellow drop lines in the left-hand scale versus yield, the blue bars in the right-hand scale. And first thing I'd point out is the higher yielding opportunities tend to be in the US and the UK because interest rates are still here. You won't think it, but they are relatively high if you consider where rates are in Europe. In fact, looking at the Eurozone government bond markets, which are about 6.6 trillion in size, 40% of them trade with negative interest rates, which is a startling number. So, we think Eurozone governments, with the exception of selected periphery government markets, do not represent good value because rates are very low or negative. You don't want to pay to hold something. And any carry you earn will be quickly erased by rising interest rates. US high yield, yields look quite attractive, but remember you've got a high energy component and about 30% of that market currently trades at distress levels. So anyway, that should give you a little bit of a feel for the type of opportunities in the market. What would a MAC portfolio look like? This is just an example for perhaps more of a Euro investor, where on the continent we tend to find investors are looking for cash plus 3%. Here that would equate to maybe more like 4 to 6. But in terms of asset classes, you'd expect to see a decent allocation to loans, high yield, maybe some emerging markets, financials, investment-grade corporates, and asset-backed securities. So possibly with interest rate duration hedging and currency hedging. So key takeaways from today: multi-asset credit can take many forms. So total return, absolute return, because the strategies are unconstrained versus a benchmark, they can take many forms. But they have, obviously, risk frameworks to help manage them and guide return expectations. They can complement a government bond portfolio or a corporate bond portfolio or sit in the return-seeking bucket of the scheme. The risk return can be customized or tailored to the scheme's needs. And I think it's very important to take a holistic approach and have very good risk management tools and discipline in order to properly manage the portfolio. And that's it. I think, thank you very much. I think David has some questions.
Yes, I've got some questions that have been fed into me, which I'll ask you, Ross, and then we'll take questions from the floor or the web. You talked about central bank policy. How concerning is the rate uncertainty? The ECB and Bank of England are taking their own course. What can you share with us about sentiment in Europe and ECM views of the tightening cycle, like pace and implications?
Thank you. We think broadly, rates look like they could stay lower for longer. So in ECB, in terms of economic cycle, we've just had another rate cut today, so 10 basis points to the deposit rate, 5 basis points of the main refinancing rate, an increase in QE, and new LTROs announced for the banks. Why is that happening? Well, in Europe, we're still in deflation. If you look at February's inflation number, negative 20 basis points. Core CPI was just 70 basis points. So there's softness in industrial goods and services. So, whilst unemployment is improving and there are signs of improvements within the economy, it's a long road. It's a slow process, and there's plenty of slack in the economy. So in terms of Europe, we're expecting to see rates continue to remain low for some time. In the UK, you've also got very low inflation, just 30 basis points. Again, spare capacity in the market. The UK tends to be more closely correlated with the US. But when we look at things like unemployment, the US and the UK both have almost structural unemployment levels and very low levels of wage growth. So, given that sort of background and with the spare capacity in the economy, again, and with Brexit, we expect the Bank of England to hold. And the market's pricing in, I think, the first rate rise something beyond 2018, probably 2019. So rates lower for longer, which means with respect to the fixed income portfolio, it might be even more important to ask it to work harder in a very low rate environment.
Okay. Political risk. Europe's been successful in executing debt and deficit strategies, and there's been noticeable improvements in the banking sector. QE in the surface has been a success, but of course there are looming issues. How concerned are you about increased political risk, regional risk, and migrant issues?
Yeah, this is got a very interesting question. I don't know if it's been discussed at the conference at all yet, but with respect to immigration and migration, when we look across Europe, we see two main drivers of political risk, and they are immigration for the whole of the European Union, and migration is more of an issue at the moment for the UK. And then, I guess, austerity and unemployment is the bigger political driver for the UK, austerity, or perceptions around austerity, and for Europe, austerity and unemployment. And this is a BBC infogram. It just shows the route of the part of the majority of immigration from North Africa, Libya, but mostly from Syria, coming through Turkey into Greece, up through Macedonia. And last year, most of the immigration refugees ended up in Germany, as Angela Merkel had pretty much an open door policy and took in 1.1 million refugees. Very little, arguably, elsewhere within Europe on a relative basis. And it's a situation which is very difficult politically and in terms of the sheer human traffic element to deal with in a sensible way. So there's no clear solution or framework at the moment, and you can just see how politically it is challenging, because even achieving a deal with Turkey means obviously making a significant contribution. Is it 3 billion euro? It was a couple of weeks ago, now it's 6 billion euro. And then politically, you can see the Italians are very upset with respect to having to make a contribution given their budget deficit and austerity, so there's political friction. In Germany, Angela Merkel is quite dominant and doesn't really have much in the way of a challenge with respect to her leadership, but certainly her popularity has decreased recently. And what we look for as investors to cut to the chase is a shift in the political landscape and how that might impact us in terms of our view of economic risk and investment risk. So what we look for is a rise of populist parties, be they extreme left, extreme right. I haven't got a view on the politics, but I do have a view on whether it impacts my investment portfolio. So in the UK, good examples would be UKIP in France, National Front, Germany, Alternative for Deutschland, in Italy, the Five Star Movement, in Spain, Podemos. So Podemos almost formed a government in Spain recently in a coalition, and they didn't exist 2 years ago. In Greece, Syriza, and we all know what happened last year in Greece. Syriza, relatively young party. The Prime Minister of Greece, Alex Tsipras, is part of Syriza. So, again, what we look for is a shift in the political landscape, and when that can result in a shift in the balance of power, and then, cause us as investors uncertainty, which then causes volatility. And as a Mac portfolio manager, you're just trying to really avoid the uncertainties, not always play it safe, but avoid the uncertainties and avoid those hotspots. And I guess in the UK with migration and immigration, they're the hot topics with respect to the debate around Brexit, and as a result, that's why we've made a reduction in our UK allocation in our Mac portfolios.
Okay. Oil. What's your outlook for oil? How worried are you, and what exposure would you suggest people have to oil?
Yeah. Whoops. I've got this chart here. Oil, Initially when we saw the price of oil coming down from high levels, we thought it was a good thing, certainly for the Eurozone, which is a net importer of oil. We thought it helped to stimulate growth in the economy. And now, until recently, at very low levels, we haven't really seen that. So this chart puts up the supply and demand versus oil. And what we saw was a significant shift in policy from Saudi Arabia to increase production, to put pressure particularly on the US shale producers. And as a result, we have spare capacity. We have stockpiling, that's the red line, 2 million barrels a day approximately of stockpiled oil. And what we expect to see when we're at these very low levels in terms of oil price is, I guess, 2 or 3 things. Firstly, we see the impact on the producers at lower levels in terms of their budgets and budget deficits or reductions in budget surpluses. So they have to, they spend less and they invest less. And then with respect to the Eurozone, again at very low levels of oil prices, consumers start to save more, they spend less at very low levels, and corporates, again, tend to save more, so there's less of a stimulus to the economy. So we're at types of levels with respect to oil price where it's not great for the economic growth, even for those countries that are net importers. Then, of course, you've got the flip side. What's the impact at the portfolio level? Well, the impact is in defaults in certain sectors, particularly energy and the companies that supply oil and gas companies. For Europe, we're fairly well insulated. So if you look at the Euro high-yield market, the energy exposure is around 7%. That's mostly in 2 companies, which is Gazprom, it's not European, but they issue in euro, Russia, and Petrobras, Brazil. But it's really in the US, in terms of the credit markets, where most of the exposure resides and where the impact's been felt. And if you looked at that, remember that the chart with respect to returns for 2015 and yields, US high yields are relatively cheap, largely driven by the energy component. And in terms of last year's performance was steeply negative, again, largely driven by the energy component. So, generally, we think it's perhaps a little bit early. We look for, selected opportunities in credits that are oversold, but we expect to see default rates to increase gradually in the US. And I guess over the longer term, until some of the expensive production comes off stream, I guess we're talking about Brazilian offshore, tar sands, US shale. Until this supply-demand changes, the price of oil will continue to be under pressure. That's our view.
Okay. Global growth. China and uncertainty surrounding the ongoing slowdown in China, of course, has not only impacted equity markets, but has resulted in violent swings in credit spreads. Has there been an overreaction, and how is your investment team navigating its way through this turmoil?
Thank you. Yes, as a credit investor, China is something I never really talked about in my career much until recently. Then last year, for periods, it was the main focus of our discussions. So we had to learn a lot about China. And why is that? Well, it's the second largest economy in the world, so it's is very important. I guess it's less important with respect to the broader US economy, say, because it accounts for a relatively small component of GDP. But it's quite important to the stock market, because the stock market is made up of generally global companies that sell and buy goods to and from China and globally. So it's a larger component with respect to global stock markets. And what we're seeing in China is a slowdown in manufacturing. That's the blue line. And also a modest slowdown in the service sector. And China's going through a transition from a manufacturing-based economy to a service-based economy. So that has a knock-on impact on commodity prices, energy prices, materials, mining, industrial goods, etc. So what we try and do at our portfolio level, we don't have any direct exposure to China, is look at those sectors where, those metals and materials companies, etc., mining, that have exposure to the markets that China has an impact on, and then adjust the position accordingly. And actually last year we got lucky in one sector, which was luxury goods, where we had, consumer discretionary, autos and luxury goods, where we had exposure to Volkswagen. And we sold out of Volkswagen in our portfolios, not because we were worried about emissions, but it's because we anticipated a slowdown in Chinese sales growth. So we got lucky for a different reason. The right chart, though, is quite interesting because the right chart just plots the black line GDP growth in terms of percentage, and everybody focuses upon 6% growth. Is it going to be 5%? And the honest answer is who knows, because the Chinese make it up at the end of the day. But growth at the moment stated at around 6%. And I guess what one has to remember is the blue bar. What we tend to focus on also is the blue bar, which is the absolute GDP growth in billions of dollars. And I guess what I'd highlight is a 6% growth in 2014, because of the multiplier effect of higher GDP growth, is equivalent in terms of absolute billions of dollars to around 14% GDP growth in 2007. So we think generally the risks are overstated, but if the market moves, you have to focus on it and try and adapt accordingly.
Okay, now I've got one final question that was fed into me. If there's one piece of advice, Ross, you can offer clients who are struggling in this environment to balance the need for principal protection and the need for yield, what would that advice be?
Yeah, thank you. Well, I guess liquidity is quite topical, and we get asked about liquidity very often. And I think it's just important to go in very much with your eyes and ears open. There's nothing wrong with investing in illiquid assets, if you can buy to hold. And many schemes have the luxury of being able to capture the premium from illiquid assets, and it's probably a very wise thing to look to do if you're in that position. I think where people come unstuck is in the herding effect into less liquid assets. And that's something as a manager in a nimble asset class and multi-asset credit you have to be aware of. Sometimes there's herding into high yield asset classes. I guess we saw last year, a couple of failures. There was one fund called Third Avenue. So it was a high yield fund, and effectively they invested in the most horrible parts of the market, which weren't liquid. And there was a mismatch between the daily liquidity terms they offered their investors and the assets in which they invested. So I guess my bit of advice would be, just make sure that there's an alignment with respect to what you're investing in and the type of liquidity that you want, and the type of liquidity that, if it's a fund, for example, the fund offers other investors, and make sure they're very much aligned. Otherwise, you can come unstuck.
Okay. Ross, would you like to come over and join me here?
Sure.
And we'll open up to questions from the floor. We've got some roving mics and people willing to come round. So if you could put your hand up and please let us know who you are and where you're from. Gentleman there, thank you.
Thank you. David Moylan from Berenberg Asset Management. You touched on high yield and US high yield. And a lot of market commentary has been default rates should begin to pick up. However, the recent decrease in interest rates has been positive for refinancing, which should possibly be a tailwind. So are you bullish or bearish on US high yield in particular?
Yeah, we have been less keen on US high yield. We think now yields are at the point where it's starting to look tempting because everything gets dragged wider, effectively. And you're right, interest rates are fairly low in the US and globally. So in terms of refinancing conditions, things aren't that bad. I think with the high yield market, one thing we focus on are fund flows, because to an extent you're at the mercy of global sentiment and fund flows. So that can drive high yield spreads and prices. That's something that you have very little control over. So we think it's perhaps a little bit too early to look for distressed opportunities, because we're not seeing, default rates have picked up, but they haven't picked up materially. We think they're going to increase going forward. We think if you can withstand the volatility, it's probably a decent-ish entry point in US high yield. But pick the name very carefully, pick the sector very carefully. Europe's better insulated. In Europe, in terms of distressed, perhaps there's less of a ability to pick up energy names in distress, because there really isn't such a large component. Perhaps the best opportunities will come in sectors like steel, chemicals, mining, in financials, in perhaps second-tier Italian banks, etc. there'll be good opportunities. But we feel we're starting to nibble at selected opportunities, but we still think maybe it's a little bit too early.
Okay. Anyone else?
Thank you.
Gentleman up the back there, number 4.
Hello, Paul Wolf, Reed Elsevier. I'm very pleased to see that you like European bank debt. We are just considering or trying to establish a philosophy of direct lending in that area, and we're torn between the syndicated bank loan market, or rather managers investing in that, and managers investing in smaller bespoke lending directly to companies. I was wondering if you had any views on that.
Yeah, I think my view would be, and we're involved in the financials market, we run a financials fund. I'm a bit more cautious with respect to the SME lending. And many funds have gone into and opened direct lending funds. And I think you need to be really careful with respect to manager selection and their capabilities. My biggest concern is with respect to the SME sector is the banks know the business so well that I think they're going to retain the best business, with a higher credit quality, and the rest will be flushed out to the fund market. Do fund managers really understand and have the ability to originate loans? Some do, others to a lesser extent. And, if the banks are going to retain or likely to retain the best business, what's going to be left in terms of what comes out to the market that funds can invest in? Is it going to be of a higher or lesser credit quality? I would have thought perhaps the latter. And what does that mean for default rates? It could mean that we see a higher default rate than perhaps one would expect. So, I guess my preference would be to invest in the syndicated loan market. We tend to look for alignment of interest as well. So, if I were to look to invest in the SME loan sector, I'd perhaps look to co-invest, or if there was an arrangement where perhaps a manager was partnering with a bank and had some sort of co-investment agreement, because you really want skin in the game and alignment of interest in that area of the market between the manager and the bank, hopefully, or at the very least, the manager and the types of assets in which they're investing in.
Okay. Down here, David. Oh, sorry, gentleman there, and then Tim.
Thanks. John Pantle, Greater Manchester Pension Fund. We're actually interviewing next month, and I hope you're not an applicant for a global credit mandate. So I found what you're saying very helpful too. But two questions come up. You mentioned the herd issue, and we know that very quickly, people go for junk bonds or whatever. How would you sort of define the limits that we should be looking at for, if there's a sudden sharp movement upwards, where does one start to have reservations about affordability of what's being on offer? And then secondly, I think your initial slide probably incorporated currency, in terms of total returns, and that's been quite worrying, particularly obviously in Southeast Asia, not China so much, but Southeast Asia. Is there any advice on, do you go for denominated sterling dollars, or do you say we'll take currency risk, or we hedge currency risk?
Yeah, two questions. I think on herding, it's all about, I think, liquidity that you're prepared to accept, what sort of return you're trying to achieve, and trusting the manager and their capabilities. And hopefully a good MAC manager will have capabilities in different sectors. So, for example, if you were to come to us and you wanted a 6% type return, we would probably steer you away from high yield, because you've got a lot of retail money in high yield, so you tend to get more herding. And as a result, you tend to get more volatility. And we'd probably steer you towards loans, because in the European loan market, you tend to get stronger covenants relative to the very little covenants in European high yield. You don't have that retail component, and you're not a retail investor, so why do you want to invest where the retail money is? So you tend to have much better stability. So I think having capabilities in different asset classes to try and avoid some of those hot spots. And if you're in a hot spot, you've got to try and do your best to, be contrarian, perhaps get out before, all of the hot money gets out. But certainly, we see, we're surprised, even ourselves, by some of the volatility in the markets. And that's obviously magnified because of what we're seeing in the banking sector, because banks deleveraging, raising capital under the new capital directives. They've got less capital committed to trading desks, and so the buffers are no longer there. So I think I would get used to more volatility in credit. So we're not going to see equity-type volatility, hopefully, in the credit markets, but I think we should expect more volatility. On currencies, the currency markets have done surprising things. I don't know if your comment was on the yen, but clearly after the Japanese went negative in terms of interest rates, the opposite of what you'd expect to happen, and we saw the yen get a lot stronger. And again, when we invest in the credit markets, our preference is to hedge currency risk. There are firms that are very good at making alpha and generating returns through active management of currency. But certainly with respect to the more investment grade end of the spectrum, the volatility from currencies dwarfs the volatility from credit. So you tend to get increased volatility, and that can impact your risk-adjusted return. Certainly with respect to perhaps high yield and emerging markets, when you're investing in local currency emerging markets, it does make sense to allow active currency management because it's all part of the risk and return profile for emerging market investing.
Okay. David.
David Patterson, trustee of the SocGen pension scheme in the UK. I want to pick up on the liquidity point again because we've heard a lot about it in the course of the past couple of days. And I'm interested in two things. First of all, you said that in order to be effective in the space we're talking about here, you have got to be a nimble manager. Given that there is less volume in the markets now because banks are holding less inventory, how nimble can you realistically be? And secondly, related to that, the cost of trading presumably has risen, and therefore the drag on performance from the spread between the buying and selling prices that you incur must be becoming quite significant. I wondered if you were able to put a figure on that for a typical year of your funds.
Yeah. Excellent question. What I've noticed, I track portfolio turnover stats across our managers, and what I've noticed over the years, portfolio turnover has come down. And I think what I said is, you want active asset allocation, because that's a sign of a healthy multi-asset credit portfolio manager. But that's inconsistent with portfolio turnover coming down. And that's as a result, largely as a function of lower levels of available liquidity. But how we combat that is we tend to have, if you remember, when we structure the portfolio broadly, say 2/3, 65% of the book being more of a beta book, which we do hold over a longer investment horizon, so we don't incur those transaction costs. And that's based upon views of the credit cycle, what credit sectors do we like over the next 12, 18 months, the economic cycle, where we see valuations going, market technical drivers. So that's more the buy and maintain. That's the beta book. And then the third of the book is the alpha book, where we trade it more actively. And that tends to be in more liquid asset classes in investment grade. I don't track the impact of trading costs at the portfolio. From time to time, I have calculated it, and it probably is something like, I don't know, up to 25 to 50 cents, I guess. It's not inexpensive. What we try and do is have very good relationships with our counterparties. In fact, SocGen is one of them. Very good relationships with our trading counterparties. We use electronic platforms more to access liquidity, to try and be nimble. But I think it's very important to have a very good investment strategy, because if you're going along with the herd and you're trying to sell when everyone else is trying to fit through the same door, you're going to pay a lot more for liquidity. So what we try and do is make the asset allocation decision early. It's not always easy to do. And sometimes you perhaps get into a trade a little bit too early, and you have to be patient, or an allocation, and you have to be patient. But we just try and think about that when we have our strategy meetings, and maybe be a little bit brave and contrarian to get in at a decent entry level. But it is a factor, and it's something we have to live with. I don't really see liquidity for the fixed income markets improving dramatically, despite the efforts of BlackRock and others, and to standardize markets. I think it's a slow road, and it's probably never going to be what it's like back in 2006. That's probably a good thing, because the liquidity was perhaps artificial then, and it's probably more realistic today.
I'm conscious of the fact time's moving on, and we're just about complete. Time for one final question. Any more questions? You're all ready for a cup of tea. Two final things from me. First of all, can I remind you, you can do your appraisal of this session either on Twitter or on the conference app. Secondly, Wells Fargo have kindly got some handouts that are lying at the front if you want to come down and take one that summarises some of the very good points that Ross has made. And finally, ladies and gentlemen, can I ask you to thank Ross, who's been an excellent speaker in the usual fashion.
Thank you very much.
Well done.
Thank you very much.
Goodbye.